Should you invest in real estate in your own backyard, or should you pack your imaginary bags, open Zillow, and start buying properties in some sort of supposedly landlord-friendly state 1,000 miles away? According to the internet, the answer is obvious. Your hometown is terrible, there are no deals, the taxes are too high, the regulations are too strict, and population growth is too slow. And wouldn't you know it, the only market with any opportunity happens to be the exact same market where the guru that is giving you this advice is raising money to buy his deals. What an incredible coincidence. But here is the truth. There are enormous advantages to investing in your own backyard. There are also legitimate reasons to invest outside of your market. The problem is that most people make this decision using oversimplified metrics like population growth, landlord-tenant laws, or which city is currently being hyped on a podcast. And that can get very expensive. By the end of this video, I'm going to give you a 5-part test that you can use to determine whether your backyard is actually a viable place to invest. And if it isn't, I'll explain what I believe you should do instead, because blindly buying a building in an unfamiliar market may be the most dangerous ways to solve the problem. My name is Matt Druin. I've been investing in real estate since 2006, and I built an $18 million portfolio of multifamily office, retail, mixed use, and commercial properties. Through Go Bigger Sooner, I help experienced residential real estate investors stop buying one little property at a time and land the biggest real estate deal of their lives. The goal is not to spend the next 20 years slowly collecting duplexes. The goal is to find a scalable acquisition strategy that can add hundreds of thousands of dollars to your net worth and meaningfully recurring cash flow without necessarily moving across the country, quitting your job, or becoming a full-time property manager. And one of the first questions investors ask is, Matt, should I continue investing where I live, or should I find a better market? And my answer is the answer that nobody really likes, right? It depends. But it does not depend upon things that most real estate influencers tell you it depends upon. So let's start by giving the out-of-state argument its strongest possible case. There are absolutely situations where investing outside of your backyard makes absolute sense, okay? Number one, a more favorable regulatory environment. Some states and municipalities have more liberal regulatory frameworks for property owners. And by liberal, I don't mean politically liberal. I mean that property owners have more freedom to operate their properties, adjust rents, remove non-performing tenants, complete redevelopment projects, and respond to changing market conditions. In a heavily regulated market, you may face rent stabilization or rent control, longer or more expensive eviction timelines, restrictions on lease renewals or non-renewals, higher property taxes, expensive inspection requirements, complicated zoning and entitlement processes, limits on security deposits or late fees, mandatory relocation payments, or expensive environmental or energy mandates. Those regulations can reduce flexibility and increase risk. A property can look profitable on a spreadsheet, but that spreadsheet may assume that you actually execute the business plan. If your plan requires renovating units, replacing problem tenants, increasing rents, changing the use, or obtaining approvals, the regulatory framework matters enormously. So what is the counter argument? All right, regulation is not automatically bad for every investor. Strict regulation can discourage new construction, push small operators out of the market, and reduce competition. It also creates substantial barriers to entry, and barriers to entry can protect the operators who know how to navigate them. If everybody is afraid of a market, pricing may become more attractive. You may encounter less sophisticated competition because investors from outside the area refuse to touch it. The better question is, do I understand the regulations well enough to price the risk and build a strategy that works with them? Complexity is dangerous when you do not understand it, and complexity can become a competitive advantage when you do. So number two, population growth and economic expansion. The next major argument for investing out of state is growth. Growing metropolitan areas can offer increasing housing demand, new job creation, expanding infrastructure, new business formation, higher household formation, rent growth, appreciation, and greater liquidity when it is time to sell. When a market is adding people, jobs, income, and productive capacity, demand can rise faster than supply. That can create a beautiful tailwind. But here is where investors oversimplify the analysis. Population growth is not the only source of demand. A market can have relatively flat population and still experience significant income growth. If the same number of households earn more money, those households can support higher rents, better retail, more services, higher home prices, more office demand, more discretionary spending, and increased commercial property values. Imagine a city of 100,000 households. The population stays relatively flat, but household income increases by an average of $10,000 per year. That is another $1 billion of annual income flowing through the local economy. That money does not disappear because the population chart looks boring. Some of that flows into housing, some flows into restaurants and retail, and some flows into healthcare, entertainment, professional services, and small businesses. Population growth does matter, but population growth without income growth can also create problems. More people do not automatically create profitable real estate if wages are stagnant, insurance is exploding, construction costs are high, and new population cannot afford the rents required to support your purchase price. So you should not only ask, are more people moving here? You should ask, is the economic capacity of this market expanding? That includes population, income, employment, business formation, productivity, infrastructure, and the quality of jobs being created. Number 3, geographic diversification. Another legitimate benefit of investing outside your backyard is diversification. If your business, personal residence, employment income, and entire real estate portfolio are all located in one metropolitan area, you have concentrated exposure. A major employer leaves, a major industry contracts, a natural disaster hits, taxes increase, insurance carriers pull out, a local law changes. Suddenly, every part of your financial life is affected at the same time. Owning in multiple markets can reduce that concentration risk. The counterargument to this is diversification is only helpful when you actually understand what you own. Buying mediocre properties in 5 unfamiliar states is not sophisticated diversification. It may simply be 5 different flavors of ignorance. Every new market introduces another set of contractors, property managers, attorneys, lenders, brokers, tax rules, insurance issues, tenant expectations, neighborhood dynamics, and regulatory risks. Diversification can reduce market concentration while dramatically increasing operational complexity, and complexity has a cost. And for that reason, that's the reason why I've been investing in the city of Rochester, New York for the past 20 years, okay? I am an expert in that field. And so I know all of the rules of the game. So when I know the rules of the game and also the cost to follow those rules, I know what I can afford to pay for a property when there's a lot of other investors that either fail because they pay too much or people just stay out because it's just too complex for them. So part 2 is the case for investing in your own backyard. Okay, so now let's talk about the advantages of investing locally. Invest where you have an unfair informational advantage, but boring advantages make people rich. So number 1, local market expertise. When you invest where you live, you know things that do not appear in a broker's offering memorandum. You know which side of the street is better, you know which school district parents want, you know where traffic backs up, and you know which neighborhoods are improving and which ones have been up and coming for the last 27 consecutive years. You know which employers are quietly expanding, you know which employer may be preparing to leave. You know where the city is investing in infrastructure, and you know which downtown block feels safe at noon but empty at 6 p.m. And you know which suburban retail center looks tired but has incredible traffic. That is valuable information, and information is one of the greatest competitive advantages in real estate. And when you leave your home market, you voluntarily surrender all of that advantage, and you become fresh blood entering the water, and the sharks can smell it. How many of you have watched a building in your community get sold to some guy from California with more money than brains at a 1031 exchange, right? The listing says, rare, value-add opportunity in a rapidly emerging submarket. Every local says, you paid how much for that? And every local person who knows nothing about real estate understands that that location is terrible and that ultimately is a bad deal. The buyer discovers that about 18 months later. All right, so now, to be fair, sometimes the California investor is right. Maybe the building still looks cheap compared to what they were used to paying, all right? Maybe they have a lower cost of capital. Maybe their business plan is different. But many times they're simply operating with an information disadvantage, and they paid for their education at closing. Number 2 advantage is your existing network. All right, investing locally gives you access to relationships that you may have spent decades building. And this is probably the most important reason, relationship infrastructure. You may already know community bankers, credit unions, contractors, attorneys, accountants, property managers, real estate brokers, local investors, government officials, insurance professionals, and potential tenants, right? And all of these things have value and are very difficult to recreate. And the unfortunate thing is that those relationships are not easily portable. A lender knows you may stretch on a deal because they trust your character and execution ability. That is not luck. That is the compounding value of local relationships. And you can build those relationships in another market, but it takes time, sometimes years, and sometimes decades. Number 3, better oversight and lower information risk. When a property is 15 minutes away, you can drive past it. Okay, you can meet the contractor, walk to a vacant unit. You can see whether the landscaping is being maintained. You can talk with neighboring property owners. You can verify that the completed renovation is actually completed. All right, so when a property is 1,200 miles away, you're dependent upon somebody else's interpretation of reality. And I can't tell you how many investors I know that have invested out of states have become victim of this very thing. And that does not mean remote investing cannot work. It means that the quality of your team becomes existential. And a dishonest or incompetent property manager 3 states away can destroy your investment before you fully understand what is even happening. Number 4 is local reputation and deal flow. Real estate is a relationship business, especially commercial real estate. So the longer you operate in a market, the more likely you are to encounter off-market and lightly marketed opportunities. So sellers know who closes. Brokers know who wastes their time. Lenders know who solves problems. Attorneys know which estates may eventually sell. Contractors know which owners are tired, and tenants know which buildings are poorly managed. Your reputation becomes a form of deal flow. When you enter a brand new market, you have no reputation, okay? And like I've heard the quote before, it takes you a lifetime to build a reputation, and it takes 15 minutes to lose it. So you are just another name in an email inbox claiming to be a serious buyer. So part 3, the dangers of investing locally. Now let's challenge the local investing argument, because familiarity can also make you blind. Number 1 is a familiarity bias. Sometimes investors assume their hometown is a good market simply because it is familiar. They confuse comfort with opportunity. They say, I know this neighborhood, but everyone else knows it too. And there may be too much competition. Pricing may be irrational. Taxes may make the economics impossible, and the available properties may be too small to support your goals. The market may be dominated by one declining industry, or the local development process makes your strategy unworkable. You should never buy locally merely just because it feels safe. But familiarity is an advantage only when the underlying economics make sense. Number 2 is the concentration risk. So as we discussed earlier, investing locally can concentrate your wealth. If you already own a business, a home, and several rentals in the same city, buying another 20-unit property may increase your exposure to the same economic and political forces. And at some point, expanding geographically may be prudent. But expansion should happen because it improves the portfolio, not because a guru told you that Alabama is landlord-friendly. But to this, I am one that has incredible concentration risk. And one of my biggest mentors in the world, one of my virtual mentors, is Warren Buffett. And he once said, diversification is for dummies. And that's what I live by. So number 3 is limited scale. Some markets simply do not have enough inventory for a particular strategy. All right, you may live in a small community where there are only 12 apartment buildings in meaningful size. You cannot build a scalable acquisition strategy around 12 properties unless you intend to wait a very long time. Or perhaps there are plenty of properties but the deal sizes are too small. So if your financial goal requires acquiring $3 to $5 million of real estate annually, and your local market produces one suitable property every 3 years, you may need to expand your geographic footprint. However, before you abandon the market, consider changing the actual asset class. So there may not be enough apartment buildings, but there may be small industrial properties, neighborhood retail centers, medical office buildings, mixed-use buildings, self-storage, mobile home parks, commercial condos, owner-occupied businesses with real estate, underutilized office buildings, or adaptive reuse opportunities. Sometimes the market is not the problem. Sometimes your acquisition strategy is too narrow. I was going through the onboarding process with the client the other day, so I figured it would be appropriate time right now in this video to actually explain what I'm talking about. So this particular client is based out of Greensboro, North Carolina. They have about 6 investment properties, mostly all single-family rentals. So we were going into seeing if Greensboro, which is in the backyard, actually has a viable environment to build a scalable acquisition footprint. All right, so out of all of the properties exist, commercial properties, this includes multifamily, industrial, retail, and office. How many actually exist within this metro area or MSA? All right, so there's 19,000 properties that actually exist. So what I want to do when I onboard a client and develop their acquisition strategy, I want to get down as close to between 300 and 500 as possible. So why 300 to 500? It's because 2 to 4% of properties within any criteria set will change hands each year, typically off market. All right, 80% of transactions will trade off market in commercial real estate. How I help my clients is I help them get on the A list so they get first look and distribution to these opportunities before everybody else knows about them. Okay, so in here, let's think about, okay, so if we're looking at multifamily properties, okay, between 10 to 50 units, which is typically the deal size that I help my clients with for, their first larger deal. Okay, so We got about 363 properties that actually exist that are between 10 to 50 units. So Greensboro may have certain zip codes and neighborhoods where you wouldn't even want to own a property if somebody gave it to you for free, okay? So when I actually refine this down further and we find that, okay, after we refine the criteria and it's more close to 200, then we'll want to actually look either changing the asset class or actually going to an adjacent market, which this one, the nearest metro area is Winston-Salem, for instance. So we may look into Winston-Salem because it's not too far of a drive away, and we can actually incorporate that into our acquisition criteria, okay? So, but if we change something, just one little thing, and we change it to, like, let's say small retail strip plazas between 10,000 to 50,000 square feet, which is another asset class that a lot of my clients do, there's 905 properties, okay, that exist. That's nearly 3 times the amount. So this is a much more abundant market. So if you live, I guarantee you anywhere in the country, there is a way to build a scalable acquisition strategy in your own backyard if that is what is best for you. It not only allows me to pull up all of the properties that are on market and also off market, but also allows me to pull data analytics such as like market capitalization rates to see if the pricing in the market is actually conducive to cash flow and also appreciation, but also understanding stuff that's like properties under construction that are in a similar asset class, what headwinds they may be facing in terms of unsustainable production of new inventory, whether it's multifamily or retail, office, or industrial. So if you ever want me to hop on a call with you and determine and look into your market utilizing the same software, I'd be happy to do so. So let's get back on track. Let's go into part 4 and why gurus love out-of-state investing. All right, so we need to discuss the incentive infrastructure behind some of the advice you hear online. Why do so many real estate gurus tell you that you should never invest in your own state? All right. Sometimes the advice is legitimate, but sometimes they need you to believe 3 things. Number 1, your market has no opportunity, which I can prove to you that it has more opportunity than you actually think. Number 2, you cannot exceed without access to a superior market. And number 3, they have access to that superior market. And conveniently, they also have a fund, a syndication, a mastermind, a turnkey company, brokerage, property management company, or investment opportunity located there. So their conclusion may not be wrong, but you need to understand how they are compensated. All right, so whenever somebody tells you that your hometown is uninvestable, ask, what are they selling me as an alternative, okay? But do not outsource your market analysis to someone whose income depends on your conclusion. So part 5 of this training is the 5-part backyard viability test, okay? So how do you determine whether your own backyard is a viable market? Okay, so here is a 5-part test that I promised you. Test 1, is there durable demand? All right, so look beyond population growth, all right? So study household income growth, job growth, major employers, employment diversity, business formation, household formation, infrastructure investment, educational and healthcare institutions, inbound and outbound migration, and rent and occupancy trends. You are looking for durable economic demand. And I would rather prefer an economy that is sort of like, steady Eddie rather than this boom bust cycle that you see in markets like we're seeing right now in Austin, Texas, and Arizona, and various parts of Colorado. A slowly growing market with stable employers, rising incomes, and constrained supply may be safer than a boom town dependent upon one industry. And also the other thing to consider too is that, when you go to a different market and you see construction all over the place, right, for multifamily housing, you're seeing cranes all over the place, okay? And you're thinking, oh my gosh, this is a boom town. I can't believe how much is going on here. You have to consider the actual development process and time frame. So even with the most liberal development regulatory infrastructure for whatever a developer's building, just remember they made that decision to build that property and having the shovels in the ground. They made the decision 3 years ago, and they're basing that decision based upon data that's 3 years old. All right, so you have an extreme rearview mirror dilemma, okay? And at the same time, all the other competing developers that were producing the same exact product were using the same data, all right? And they weren't trading notes or anything like that because they're using the same data, and now they're building. And now this is where you have a glut of apartment inventory and single-family home inventory in a given market. So that is one thing you want to be very, very aware of, especially if you are investing in a market that has a lot of quote-unquote construction growth. So that being said, the question is not whether the market is exciting. The question is whether people and businesses will continue needing space. Test 2 is there enough inventory? Okay, so you need a sufficiently large pool of potential properties to build an acquisition strategy like we help our clients with. So if your criteria only produces 9 possible buildings, you do not have a scalable strategy, like I detailed in the previous section of the video. And you're more likely going to be on a scavenger hunt, all right? So I like to identify a large enough universe of potential acquisitions that I'm not emotionally dependent upon every single deal. So ideally, you want hundreds of possible targets over time, not 5 properties owned by people who have no intention of selling. So test 3 is, can the economics actually work? So you want to look at purchase prices, market rents, vacancy, property taxes, insurance, utilities, payroll, repairs and maintenance, management expenses, financing terms, capital expenditure requirements, exit cap rates, and also replacement costs. Do not assume that a low purchase price means a good deal. Some properties are cheap because the rent ceiling is low and expenses are high. Likewise, a high growth market is not automatically attractive to if investors have already priced in 15 years of future growth. Growth is valuable, but overpaying for growth is not. Test number 4 is, can you operate within the regulatory framework? All right, so understand the rules before you actually buy. Can you increase rents? Can you renovate occupied units? How long does an eviction take? And are there restrictions on non-renewals? All right, so what inspections are required? All right, what is the zoning? Can the property be converted to another use? Are there environmental requirements, such as in New York State, they passed a mandated electric conversion thing there, so we can't build homes with natural gas. So that actually stalled several multifamily developments from actually being built that were already entitled and approved. So you want to be aware of that. And then are taxes reassessed after a sale? And can you legally execute the business plan? And regulation should not automatically disqualify a market, but you need to be paid for that difficulty. If a regulated property is priced exactly like an unregulated property or a relatively unregulated property, you may be accepting more risk without receiving the commensurate return. And last but not least is test 5. Do you have or can you build an edge? All right, so your edge might be local knowledge, relationships, access to capital, construction expertise, property management capability, a tenant network if you're doing retail, industrial, or office, a unique sourcing strategy, a specialized asset class, speed, reputation is really important, or creative deal structuring. You do not need to know everything about a market, but you need a reason that you should win. All right, so if your entire strategy is the city appeared on a list of the 10 places to invest, you do not have an edge, you have an internet connection. So let's say you honestly evaluate your market and conclude that it does not support your goals, okay? Typically speaking, for the clients I serve, it's typically a scarcity in inventory, okay, that is out there. And I'm not talking about property that's actually on the market. I'm talking about the actual product, buildings that are on market and off market. If there's not enough there, typically that's associated with, it's an extremely rural community. We're talking about like Deliverance rural, where there's no metro area, there's no employment center, anything like that. That may necessitate you to have to shift markets, okay? Or let's say you live in a location that is just not conducive to this. Like I have a client that actually lives in American Samoa, all right? And actually did the research and there is really no commercial property. There's no commercial property industry in American Samoa. Okay, so we had to find another market within the US that would support his long-term wealth appreciation goals as well as his cash flow goals. So assuming that your market does not meet the test, okay, what should you do? All right, so you have actually several options. Option 1 is expand to the nearest metropolitan area. Okay, it may sound kind of obvious, but you may not need to move across the country. You may need to expand your radius by 30, 60, 90 minutes. This allows you to maintain many of your existing relationships while accessing a larger property base and a more diverse economy. And there's an enormous difference between investing 75 minutes away and investing 3 time zones away. And that being said, if you are focusing on other asset classes besides multifamily, because 70% of our clients are buying 10 to 50 unit multifamily complexes, but if you're focusing on retail, industrial, and office, those asset classes have a fraction of the management intensity than multifamily, which means you can actually expand your geographic reach and it won't become inconvenient for you. Because the beautiful thing about commercial is that the tenants take care of everything that's inside their box. You maintain the common areas and the structure, and you can do a lot of this through actual contracted services, okay? Like your lawn maintenance, your snow removal, your HVAC person that does the preventative maintenance on the rooftop units, the janitorial company, and all those things. So you do not actually need to have a boots on the ground presence there. So you can conveniently own a property that is 1-2 hours away from you, that is in an area that has better economics than when you do multifamily, okay? So option number 2 is changing your acquisition strategy. Okay, so perhaps your market is terrible for small residential deals, but excellent for industrial properties. I just did exercise in the previous section of the video in the video above, where, for 300 multifamily properties between 10 to 50 units, there were 900 properties that were between 10 to 50,000 square feet. Okay. So maybe apartments are overpriced, but neighborhood retail is ignored. All right. Maybe office buildings are distressed, but medical tenants still need space. Maybe the best opportunity is buying an owner-occupied business property and then doing a sale leaseback and leasing it back to the former owner. So do not confuse my market strategy does not work here with there are no opportunities here, okay? Because if you're willing to actually go outside of the safety and familiarity with residential, then you can actually have an immense amount of competitive advantage in your market, because I guarantee you there's not a lot of buyers for those types of properties. So you can have a minimal amount of competition. So that's how my client bought a built 22,000 square foot medical office building off market. Nobody knew about it, for $1.3 million. And fast forward about 12 months later, it's worth $2.85 million. And then after he pulls $1 million in cash out of that property, it's still going to cash flow him about $60,000 a year. Those opportunities exist in markets across the country if you're willing to consider outside multifamily. But that being said, 70% of the clients that I work with are focused on multifamily. So if you can't wrap your head around that, then you may need to look a little bit outside the box. So if you live anywhere near a meaningful metropolitan area, I'm confident there is some form of commercial real estate acquisition strategy that can be both lucrative and scalable. And the opportunity may not look like what you originally expected. So option number 3 is partner with an established operator. All right. So if you identify a market that meets your criteria, but you do not have the expertise, relationships, or operational infrastructure to invest there directly, consider partnering with someone who does. That may mean investing passively, and it may mean bringing capital to an experienced operator. There's nothing inherently superior about owning 100% of a property that you do not understand. Sometimes owning a smaller percentage alongside a great operator produces a better result with actually less risk. But you need to conduct real due diligence. And a great market does not rescue a bad operator. So here's my pointers on actually finding a operator to invest with. One, experience. And generally what I look for, because I invest passively with real estate syndicators across the country, is that I want to look at least that they've brought 5 to 10 investment opportunities full cycle, meaning that they bought the property, they renovated it, they refinanced it, delivered their investors' capital back to them, and then they did that 4 more times or more, okay? That is a bare minimum on whether I'm going to consider even looking at the numbers on their deal. So should you invest in your own backyard or out of state? Here is my answer. All right, start with your own backyard, but do not give it a participation trophy. Evaluate it honestly. Does it have durable economic demand? Is there enough inventory? Do the economics work? And can you operate within the regulatory framework? And do you possess a meaningful competitive advantage? If the answer is yes, then even if it never appears on a guru's top 10 list. And if the answer is no, expand deliberately. Move into an adjacent metropolitan area, or change your asset class, or partner with an experienced operator in a market that matches your criteria. That all being listed in order of priority, right? So the least of the priority is changing markets and partnering with an operator. Okay, so you have so many other avenues and pathways to follow before you actually give up on your own market and go to a different one completely. Do not surrender decades of local knowledge simply because somebody on the internet said the population growth is higher somewhere else. The best market is not necessarily the market with the fastest population growth. It's not necessarily the market with the lowest taxes. And it's not necessarily the market with the weakest tenant protections either. And it is definitely not automatically the market where your favorite guru happens to be raising money. The best market is the place where solid economic fundamentals intersect with a strategy you understand and an advantage that you can exploit. You do not need the hottest market. You need a market where you have a reason to win. So if you are an experienced real estate investor and you are trying to identify a scalable commercial real estate acquisition strategy, either in your own backyard or in a nearby metropolitan area, that is exactly what we help people do inside Go Bigger Sooner. We will learn more about your experience, your market, your financial goals, and the resources you already have available. And even if you're not the right fit, we point you towards the same strategies and tactics we're using with our paid clients. So until next time, stop assuming that the opportunity is always somewhere else. And sometimes the biggest deal of your life is hiding in plain sight, 15 minutes from your house.